As 2021 draws to a close, many are reflecting on the past 12 months and preparing for the year ahead, personally, professionally, and from an investment perspective, which often means reevaluating long-term asset allocation, particularly important as we enter another long, potentially volatile economic cycle. In this current market environment, yield and diversifiers are particularly important to investors, which brings us to today's topic of discussion, real estate. My name is Anu Rajakumar, and joining me today is Matthew Walpert, Portfolio Manager for Almanac's Public Market Real Estate Strategies, to share his thoughts about the real estate investment outlook ahead. Matt, thanks very much for joining me today.
Thank you for having me.
So Matt, you have an interesting perspective on this topic considering your role as an investment decision maker, which is primarily on the public real estate side, but your team Almanac generally focuses on private real estate. So just to get us started, what do you see as the main components of the current real estate investment landscape at play? And maybe just compare and contrast trends from the public and the private side.
Yeah, thank you. It's really interesting sitting between public and private markets, particularly in real estate, because at the end of the day, public companies, their underlying assets are real estate. On our private side, we're investing in real estate. And we try to bring a long-term focus to both. And yet the public markets, prices move every single day. And whatever the headline of the day is can cause huge swings in the prices of public real estate companies where the assets they own haven't really changed very much. And on our private side, when we're making decisions for the next 5, 7, 10 years, you have to take that long-term view. And real estate is this stable, hard asset that generates cash flows, that has stability. And so sitting between the two, what ends up happening is you can really see when opportunities come up. And whether that's in the public markets where prices are changing, but the underlying assets aren't, or whether the public markets are signaling that prices in the private market aren't right. Maybe they're too low for specialized real estate, or they're too high for legacy real estate, I'll call it, like office or retail or malls. And so it's really a great place to sit and try and make good long-term investment decisions, seeing both sides at the same time.
Yeah, no, that's a great primer. And real estate is something that I think affects everyone. So now turning to real estate sectors, as we all know, office space has been very challenged because of the pandemic. And at the moment, you and I are sitting about 6 feet apart in our New York headquarters. And like Neuberger, a lot of companies have launched hybrid work programs or are fully back in the office. So maybe this is a good place to start. How has the office space real estate sector been impacted?
Yeah, so that's a good advertisement for return to office. I think anyone who invests in real estate appreciates your advertisement. Office is indicative of what COVID and the long-term changes that COVID has really caused on the real estate market. And I think if you take a step back and you go back to March of 2020 and look at what the impact has been, there's really been this dichotomy between sectors that really had a huge detriment from the physical world shutting down, and office is case in point. I think people largely would think about hotels in the same way where, not only did offices empty out because no one went to the office, no one went and traveled to a hotel, no one wanted to walk around a mall, no one wanted to access the healthcare system. And on the other side, you had these subsectors that benefited from this shift to the digital world. So industrial real estate had a huge benefit from e-commerce as a share of total sales skyrocketing and everyone ordering from Amazon at home. Same thing with a move to the cloud. Again, we at Neuberger Berman, we all went remote and we were all accessing our computers via the cloud. And there was a huge pickup in demand for data center space, really, in that movement to the cloud. And then towers, the rollout of 5G and the importance of 5G and connectivity in a much more digitally enabled world. So the different impacts to subsectors have been very stark. The outlook for office is probably a little bit more uncertain than others. I think everyone is trying to feel out what works best for their organization and their employees. It does seem like employees appreciate a flexible work environment. And so what that means for office longer term is if people aren't going into the office 5 days a week, let's say they're going in 4 days a week, well, that's 20% less people flowing through an office building. And maybe you still need the same amount of space to distance people, but at the street level, the ground level, there's a real impact to businesses that maybe are, selling food or selling goods. And now there's 20% less foot traffic during the week. So Office in particular probably has the cloudiest outlook, I'd say, over the medium term. And the longer that COVID goes on and the longer we're remote, probably the more it's impacted.
Yeah, sure, absolutely. And you mentioned a couple of other sectors there where there's, potential opportunity. One that I find interesting is lodging and hospitality. It has impact from both business and from leisure travel. And there's a lot of pent-up demand. What's your view there, and how do you weigh up some of the risks, particularly as we think about new variants of COVID that have come along and probably will continue to evolve and come along too?
Yeah, so it's very topical with Omicron and the impact Omicron's had on public markets over the last 2 to 3 weeks. It's interesting. If you put office in the camp of cloudy forecast, hard to know. There'll be winners and losers. It's really dependent on the asset and the market. I'd say, in my opinion, lodging, the outlook over the longer term is a little more clear. So we've seen leisure travel well above pre-COVID levels. And so Americans have shown they want to go travel on their own. People are more comfortable staying in hotels. We've seen rates in leisure markets 20, 30% above where they were pre-COVID. We saw TSA travel, the amount of people actually flowing through airports during the Thanksgiving week was nearly back to 2019 levels. And so leisure demand is there. And the question longer term is, when does business travel come back? How does it come back? When do groups come back? But my opinion is people have already shown they're comfortable staying at hotels. And once we get a little further out from Omicron, from the initial wave, that the vaccines work, that people are comfortable traveling, businesses are going to want to travel too. People are going to want to see the client on the other side of the table. People are going to want to meet with the people that they do business. And if anything, maybe you travel less, but every time you travel longer, because now you can work from anywhere. And so, the outlook for lodging as one of those really impacted sectors from COVID, I think is pretty favorable relative to some of the other sectors where it's a little hard to know how it's going to play out.
Yep, sure, absolutely. So I want to shift a little bit to talk about some macro topics. Real estate, for example, has often been considered somewhat of a hedge against inflation. We'd love to know what you're thinking about inflation, rates going forward, and how is your outlook on these macro themes impacting the opportunity set within real estate?
Yeah, so real estate in the current environment seems like a pretty favorable asset class. So first of all, it's a hard asset that should have some inflation protection embedded in it. It generates current cash flow, and that yield helps generate your total return. And that yield is something that is relatively straightforward to forecast over the near term. And real estate benefits from overall growth in the economy. And so unlike a bond where you get largely a fixed coupon and your money back at the end, real estate cash flows can reprice every year or every month or every day if you're talking about hotels. And so if we have inflation, we obviously have a good deal of it now relative to historical. But if inflation continues or it picks up, you should see growth in cash flow. And that should help mitigate some of the impact that inflation can have on asset classes. As we move forward, certainly the environment's changing a little bit from a macro perspective. We have a Federal Reserve who is likely to start pulling back on some of the quantitative easing, including, tapering, potentially faster at the next meeting, potentially raising rates next year. So that's a big shift. We've had this huge tailwind from the Fed easing, and now we're going to go the other way. And then, the federal government, we passed a lot of stimulus, and that stimulus flowed through the economy. And as you look to next year, it's unlikely that we continue to have the same level of stimulus that we had during COVID. So you have two big macro drivers that were tailwinds for all asset classes that might be shifting to modest headwinds. And so in that kind of environment, real estate still looks pretty good because real estate remains somewhat discounted relative to other asset classes. You do get the current yield, like I said before, and you do have some inflation protection characteristics inside of it.
Great. No, thanks for sharing your favorable outlook on the asset class and some of those macro factors, which the ones that you mentioned are generally U.S.-centric. Looking outside of the U.S., just in terms of the opportunity set, what else are you seeing? And are you seeing those macro themes sort of are impacting the global opportunity set outside of the U.S. as well?
Yeah, one thing that remains true across the globe, despite potential tightening by the Federal Reserve or other central banks, is yields are incredibly low. And so real estate screens attractive relative to sovereign debt in most major economies. And real estate remains an asset class that most investors are comfortable that it will retain its value over the long term, particularly relative to some more speculative investments that really came to the fore in 2021, in my opinion. So globally, real estate remains attractive relative to sovereign debt. And then the second thing that we've really seen globally is housing, and a shortage of housing is a global theme. It's something that's pertinent here in the US. It's something that's certainly pertinent in other markets across the globe. So those two things I think are relevant everywhere. And lastly, other real estate markets tend to be a tiny bit behind the US. And so some of the investment themes that we saw here in the US, like I mentioned, industrial and the tailwinds from e-commerce, housing, storage, life science, all of these asset classes are investable in these other markets. And the investment thesis is actually pretty good because they're several years behind where the US is in terms of the market maturity and opportunity.
Okay, interesting. Thank you. Now, Matt, what innovations or impact are you seeing on real estate when it comes to ESG factors? This is very important to many folks in the investment community, some of whom are certainly striving for net zero carbon emissions in the near future. How does all of that affect real estate?
Yeah, so ESG is obviously a prime topic with investors, whether it's public or private markets. And real estate is particularly heavy in the E, in energy. So, the amount of energy it takes to build a new building, as well as operate a building over time, that is something that we're seeing is a large topic. I think real estate can do better in terms of becoming more ESG friendly. Part of the driver of that is technology. And there's this relatively new sector called prop tech with a lot of companies trying to disrupt the real estate market as it exists today. And one of the things that they can do is help real estate owners more efficiently manage their buildings. And whether that's energy, whether that's water, whether that's the cost and how we build buildings, all of those topics are at the very forefront of real estate investing today. And so, particularly as governments like here in New York City, there's a big push to regulate the carbon emissions from buildings. They're going to have to get more efficient over time. We're going to see that theme. The G is important too. So really interesting within Almanac, for us, whether it's investing in public markets or private markets, in public or private, governance is really top of mind. And the reason behind that is when Almanac does investments in the private market, one of the key things we do is put in place a board of directors. And in the public markets, obviously, publicly traded REITs and real estate companies have board of directors and GAAP financials and transparency. And so most real estate investments, particularly in the US, the G is lacking because you're making a private investment in an asset or a portfolio, and the governance is really based on a document that you agree to. The way that we look at it is governance is one of the most important drivers of a great investment. And so, the public markets, I think REITs are really well positioned because almost any other real estate investment that you're going to make, the governance doesn't match what you get in the public markets. And so at least two of the three components of ESG we see as really important and differentiating in how Almanac at least looks at investments.
Yeah, no, that's great. Thank you very much, Matt. Now, as we start to wrap up here, we'd love for you to share with us some of the key trends that you're anticipating in real estate investing for the next year or coming years ahead, if you can just summarize a few key takeaways.
Yeah, as we look forward to 2022, there's a few key topics. Obviously, we talked about how the macro is changing and we're not macro investors, but we believe we're going to have volatility. And if I look back in public markets, over the last 14 months, the public REIT benchmark has only been down in 2 of those 14 months, and prices are up more than 70% off the bottom from COVID. And so it might not be that easy going forward to generate great returns consistently just by owning a benchmark or by investing in every piece of real estate across the globe. And so more volatility is probably case in point, and that's driven by both, the run that we've had and the change in the macro environment. Secondarily, real estate remains really well positioned. So if we have a pickup in volatility and if we have a pickup in inflation and if growth is either faster or slower than everyone thinks, real estate is still going to do pretty well because you get current cash flow and that yield is something you can take home, every month or every quarter or every year. And the economic growth that we see going forward on a multi-year basis, on a longer term basis, should help real estate values grow over time. And so, lastly, I would just say we believe REITs themselves, and particularly in the U.S., remain incredibly well positioned, whether it's those same secular tailwinds from e-commerce or data, or whether it's a reopening in the U.S. economy that still is taking hold, which really could benefit some of these sectors that were impacted, like lodging, office, senior housing, and a long-term shortage of housing in the U.S. that really benefits single-family rentals and multifamily. And so REITs have this diverse set of underlying growth drivers that should position them really well for 2022.
Yep, no, that is perfect. Thank you very much. Now, my bonus question for you, which you are unprepared for, is, we're almost at the end of the year, so I'd love to just ask you, Matt, what's your New Year's resolution?
New Year's resolution. Listen to more podcasts?
That is the correct answer.
Okay, good.
That is excellent. Matt, thank you very much for all of your thoughts today on real estate. You've given us lots of food for thought, and clearly you've summarized there's a lot of potential for real estate as we move forward here. So I appreciate you joining the podcast, and hopefully we'll have you again on soon.
Yeah, it was a lot of fun. Thank you.
And to our listeners, if you've enjoyed this episode of Disruptive Forces, I encourage you to subscribe to the show via Apple Podcast, Google Podcast, or Spotify, or you can visit our website, www.nb.com/disruptiveforces, where you can find previous episodes, as well as more information about our firm and offerings.
This podcast contains general market commentary, general investment education, and general information about Neuberger Berman. It is for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. This communication is not directed at any investor or category of investors, and should not be regarded as investment advice or a suggestion to engage in or refrain from any investment-related course of action. All information is current as of the date of recording, and is subject to change without notice. Any views or opinions expressed may not reflect those of the firm as a whole. This material may include estimates, outlooks, projections, and other forward-looking statements. Due to a variety of factors, actual events or market behavior may differ significantly from any views expressed. Please refer to the disclosures contained in the episode notes and episode details, which are an important part of this communication. Investing entails risks, including the possible loss of principal. Past performance is no guarantee of future results.